Japan Corporate Pension Fund to allocate 1% to crypto in FY 2026. A Japanese corporate pension fund plans to move roughly 1% of its assets into cryptocurrency starting in fiscal 2026, according to a June 21, 2026 report from Wu Blockchain. The fund, identified as Japan's National Commercial Enterprise Pension Fund, manages about 21.3 billion yen, roughly $136 million, on behalf of around 200 small and medium-sized enterprises. The plan routes the allocation through a passive multi-crypto fund run by a major hedge fund, with the stated goal of diversifying currency risk. At 1% of assets, the position works out to a little over $1.3 million in crypto exposure. That is a small absolute number. The signal it sends is larger than the dollar figure. A defined commitment, not another study. Most pension headlines in this space stop at exploration. Japan's Government Pension Investment Fund, the world's largest, has spent the past year seeking information on crypto alongside forestry and gold as it reviews illiquid and alternative assets. But it has not committed retirement money to digital assets. This smaller corporate fund is doing the opposite, naming a target weighting, a start date, and a vehicle. The distinction matters because a 1% line item in an investment policy statement has to clear internal risk committees, custody arrangements, and reporting standards that a press release "We are studying crypto" never touches. Once a fiduciary writes crypto into its allocation model, the asset stops being a thought experiment and becomes a line that auditors and trustees review every quarter. Currency risk, not a price bet. The reasoning here is the part worth slowing down on. The fund did not frame the move as chasing returns. It framed it as diversifying currency risk. That language reflects where the yen has sat. A weak domestic currency erodes the real value of a pension pool that pays out in yen but increasingly buys imported goods, energy, and services priced in dollars. Allocators in that position look for assets that do not move in lockstep with the yen or with Japanese government bonds. Bitcoin and a basket of large-cap tokens, whatever else they are not yen-denominated. It is the same logic that pushes individuals toward dollar-pegged stablecoins and crypto holdings when their home currency slips. A pension fund reaching the same conclusion on behalf of factory workers and shop owners is the institutional version of a decision retail savers in soft currency economies have been making for years. Japan changed the rules first. This allocation does not happen in a vacuum. Japan spent the run-up to 2026 rebuilding the legal scaffolding around digital assets. Crypto assets are being brought under the Financial Instruments and Exchange Act, the same framework that governs securities, which gives institutional investors clearer custody, disclosure, and tax treatment to work with. A reclassification like that is precisely what a conservative pension trustee needs before signing off on any allocation. Put plainly, the regulatory plumbing arrived first, and a fund acted on it within months. That sequencing, rules then capital, is the opposite of crypto's usual pattern, and it is part of why a fund covering Japan's small business sector felt comfortable going first among its peers. A passive wrapper keeps it boring on purpose. The structure of the allocation is as telling as the size. The fund is not buying and managing tokens directly. It is buying into a passive multi-crypto fund managed by an outside hedge fund, which means no active trading desk, no in-house key management, and no attempt to time the market. That choice keeps the operational risk low. The fund gets diversified exposure across major assets without taking on the custody and security burden of holding coins itself. For a pool managing other people's retirement money, outsourcing the hard parts of crypto operations to a specialist vehicle is the cautious path, and it lowers the bar for the next fund considering the same move. The broader read is straightforward. As regulated wrappers make crypto easier to hold without touching a private key, the asset keeps drifting from speculative trade toward a normal portfolio component. The same drift that has slowly made crypto-linked spending and holding products feel ordinary rather than fringe.